Let's talk about where we are in the economy generally. You have a note out right now talking about a precarious equilibrium in the economy. What makes that precarious?
Well, look, now I've been doing this 35 years now, and the U.S. economy, in my mind, is starting to look like an emerging market economy that, or every kind of emerging market blow up that I've seen in my career. And that is you have rise in asset prices. So in the U.S., stocks and housing, that is fueling consumption by the top 10 or 20% of households. Top 10 or 20% of households or account for more than 50% of U.S. consumption. Then below that, the rise in asset prices being fueled by a 7% to GDP budget deficit, biggest we've ever had when it's not a war, not a recession. And then the third leg of that is Janet Yellen has moved the quarterly refunding to much shorter term debt, which has had the effect of suppressing interest rates. So you've got, I call it the three-body problem after the Chinese science fiction book and the famous math problem. So we don't know which one of those could go first, but it's one of these that if the stock market were to go down, then it could create a gap in consumer spending.
So that does sound pretty perilous for investors. Yep. And given the fact we don't know which one will break, although you think one of them is likely to break at some point, what does an investor do? How do they position themselves for something breaking?
Well, I think investors should be ready for more volatility, which I also talked about in the note. I think gold's very interesting here. It's at an all-time high, I think, as we're speaking today. And, I think just in general, everyone should do a gut check, make sure they're not too far out on the risk curve, because, it's been a pretty good run.